So Jennifer, let me go ahead and pass it over to you.
Awesome. Well, thank you so much, Taylor, for the warm welcome. I am super excited to be here today, and I'm really impressed that we have so many people here ready to learn and talk about taxes, which is, I would say, not like the top of everyone's list. But it's one of those things that as investors, we all have to do it, right? We all have to file our taxes and pay taxes. Except for today, I'm going to show you guys a couple of little tips and tricks that I've learned along the way of my, as I'm going on, I think year 17 as a full-time investor. And so we're going to have a lot of fun. As Taylor had mentioned, we're going to do some Q&A at the end. So please, please, please ask away. Taylor is going to monitor the chat and then we'll save them for the end. But yeah, please, I'm an open book. So any questions that you all have, I will do my absolute best to help you guys get some of these answers today. So without further ado, I'm gonna go through my presentation because we have a lot to cover. And I'm really big on case study examples and also just showing people what this looks like so that you can determine if it's gonna work for you. So yeah, let me get into my presentation here and we'll go to it. Okay, let's just get a real quick confirmation. Can you guys see my slides? Are we good? Okay,
We're good to
awesome.
go.
I'm gonna move. All right, let's do it. I'm gonna move this little window so that I can see here. All right, so today, what we're talking about is actually the STR loophole. So it's a little known tax strategy that can save hosts thousands or tens of thousands of dollars. I'm gonna show you guys what that looks like here. So we're gonna talk about how you can offset your other income and save substantially at tax time. Oftentimes what I'm seeing is that people can save between $30,000 to $50,000 in actual tax savings in the first year. So let's get to it. All right, so first, the fine print. So this session is educational and informational only, so please don't consider this legal or tax advice. We're gonna talk about how this strategy works, how myself and other investors use it. I'm gonna share a little bit of the IRS guidance, and then also really just make sure that you guys know what you should discuss with your CPA because taxes are incredibly nuanced. So just as a reminder there. All right, so here's what we're gonna cover today. We're gonna talk about how the strategy works, the IRS guidance on how to qualify. I'm gonna break down where the deduction comes from because I find that most hosts maybe have a hard time understanding how am I cash flow positive, but somehow writing off oftentimes six figures in paper losses. So I'm going to break that down in a couple of different case study examples of how the math actually maths on that. And then also I'm going to show you how to size it up for your own situation before year end. So essentially what you'll leave with is you're going to know whether this applies to you and exactly what your next step is. All right, so first, just a little bit about me. This tax strategy completely changed my life. So I bought my first property 19 years ago when I was 21 years old and spent years implementing and documenting what I've learned. So today what that looks like is we do about seven figures in revenue, paying little to no tax for about the last 15 years. So my husband and I own apartment complexes in some of the states that you all had shared in the beginning. We're actually in 7 different states right now. We also have some single family, long-term rentals, short-term rentals. We also have a pretty busy flipping business in Washington State and new builds in Washington State as well. We have an entire team that runs everything there in Washington for us. So my husband and I run everything remotely from Arizona. So it's my husband and I, and then we have 2 full-time employees that help us in this business. Because we live in Arizona, we also escape the heat for 2 to 4 months, usually every summer. So we're getting ready in less than 30 days to go spend our Euro summer in Greece and Sicily and Italy. And the only reason why I bring that up is I think a lot of people think that when you get into real estate investing that it's got to be, full-time and you've got to put all of your time and effort there. And I'm just here to share that that's not necessarily the case. You can but I say choose your own adventure. So we actually only just own our primary residence in Arizona. We don't have any rentals here. Everything else is in another state. We also build real estate and tax software so more people can use this. What I find is that obviously because these tax strategies have literally changed our lives, a lot of people still have so many questions. And so we launched our first software back in 2022 and have not looked back, really trying to help provide more transparency on how all of these things come into play. All right, so let's first talk about the problem. So the problem is the more you make, the more you pay in taxes, right? So you work really hard, your income climbs, and a bigger and bigger slice disappears to taxes. I would say the number one expense that most people pay is taxes, right? When you break it all down. So high earners can typically lose between 30 to 50 cents of every dollar to federal and state tax, depending on where you live. So here's the part that stings. So the W-2 paycheck is actually taxed before you ever touch the income, right? There's almost nothing that you can do about it unless you change the rules in which you play by, which is what we're talking about today. So again, your edge is going to be the same dollar, but opposite order, right? So for employees, you earn, you're taxed, and then you get to spend what's left, right? So the tax comes out first before you ever get that paycheck. But as owners, we get to earn, spend, and then we're taxed on what's left, which is really how it works with short-term rentals, right? So we get to deduct first and then pay the tax on what is left, or ideally, no tax. So real estate lets the W-2 earner deduct before tax just like the business owner, which is the short-term rental loophole that we're talking about and focusing on today. But first, so the rep status gave me the life. So for years, we were flipping and building houses, making really good money, but handing a massive share of that back in taxes. And then my CPA was the one that introduced me to real estate professional status, and we changed our whole strategy. So we still have a similar business to flipping and building, but we incorporated buying more rentals with the income that we were making from those activities. So for those that are unfamiliar with what reps status is, basically if real estate is your main job, meaning you spend over 750 hours a year and more than half of your working time, your rental losses stop being passive, and then they can offset all of your other income. This is how we've paid little to no tax for 15 years and counting. But here's a problem. As I said, it has to be more than half of your working hours. So what was happening is I had a lot of friends saying, how can I implement these strategies but keep my full-time job, my W-2? And unfortunately for reps, that is the catch. It has to be your main job. So I have lots of friends that are in tech. Again, they are maybe physicians, nurses, and healthcare. So obviously they have full-time careers. They couldn't qualify for reps, but they also wanted to make real estate their full-time career, but they need the cash flow to bridge that income gap. So that's when my CPA introduced me to a different tax strategy. And that's again, essentially what we're going to be talking about today. It's completely built into the tax code, and it's the short-term rental loophole. This loophole does not have that same requirement that full-time real estate be required. So here's how a little bit about how this breaks down, right? So for those, again, that are not familiar, there's a wall in the tax code. So the IRS splits your income into one of two brackets, essentially passive and active. So by default, real estate is considered passive. And those passive losses typically cannot touch your W-2 income. So the loophole isn't necessarily a deduction, it's a reclassification of this income. It's essentially legally moving income from the passive bucket into the active bucket. It was actually written for hotels. It's been around for decades, long before Airbnb and short-term rentals existed. But that loophole still exists today, which is why we can use it. So there's, again, only two ways to get to the active side. So you can either become the real estate professional pro. So for anyone that does real estate full time, meaning that this is essentially your full time job and you put in at least 750 hours and more than, any other W-2 income, then you can qualify for real estate pro. But for those of you that, again, maybe you have a part-time income or a W-2 where you're working full time, then the other way around that is to reclassify the property. And so when your average stay is 7 days or less and you materially participate, you can keep your W-2 or business, and this is the door that most people can walk through. So to break it down a little bit further, to qualify, there's 3 tests. So number 1, the property has to qualify, right? So your average stay needs to be 7 days or less. At that point, the IRS says, okay, this is no longer a passive activity. This is an active business, right? And that little nuance, we're going to break it down when we get into how the deduction works. And then test number 2, there is a personal use limitation. So what the IRS wants to avoid is people saying, okay, well, it's going to be a short-term rental, but I'm also going to use this as a second home, if you will, right? So they do have that limitation there. And it's the greater of 14 days or 10% of the days rented, which is actually pretty good. So obviously you can continue to use your property, just make sure that you use one or both of these qualifications. Okay, and then test number 3, you have to materially participate. And you actually have 2 options. One is 100 hours a year and more than anyone else, any one individual, or 500 hours total. So you can pass with either option. All right, so the 100-hour test. So again, as mentioned, it's 100 hours and more than any other individual. For most hosts, that's actually going to be your cleaner, right? So cleaning company is fine. You just have to outwork any single person, right? So that's the sweet spot. And you have to track those hours. Whereas with the 500-hour test, it's 500 hours total. And for clarity, this is per property, okay? So for 500 hours, it's essentially under 10 hours a week. You pass no matter what anyone else does. So you could have a co-host, you could have obviously, cleaners coming in. There's also no requirement to track the third-party hours when you're using the 500-hour test. So what counts? That's a big question that I get from a lot of investors. All right, so what counts is any kind of inspecting the property, obviously the furnishing and the initial setup, any repairs, if you do the cleaning, managing contractors, any on-site work, basically anything that it takes to run the business could potentially qualify, but you must document it. That's the big thing. Couple of things that don't qualify would be browsing listings, attending workshops, any kind of passive oversight, right? So again, it's essentially the easiest way to describe it is what is required to run the business. So there's also a little bonus here. Any hours that your spouse contributes counts as well. So to put it simply, if you have the 100-hour test and again, you're tracking against cleaners, you have to make sure that you do that. If you work 1 hour a week and your husband or wife or spouse works 1 hour a week, it's very easy to get essentially 2 hours a week and meet that 100-hour test. Okay, so from our own experience with our own short-term rental, year 1 is always the easiest, right? So every single hour that you spend getting the property ready counts as participation. And year 1, as we all know, is where we spend the most time. It's, furnishing, unboxing the wall of boxes, styling, everything, right? So on our own property, we spend about 14 days, like 10 hours a day getting ours ready. So we were shopping Minoan, opening boxes as they were coming in, assembling furniture, styling each room, all of the things. So 14 hours a day, 10 hours a day, my husband and I, it's about 280 hours before a single guest checked in. And again, the hours aren't as scary as they might sound. So again, the 100-hour test is like 2 hours a week, And the 500-hour test is like 9.6, less than 10 hours a week spread across the year, right? So you have the entire year to get this set up. All right, so I want to break it down really quick for those that are like, this sounds great, but how does it work and how does it look in real life? So this is not a real life example, but again, just we're using round numbers just to make it doable, and you can kind of understand how this all comes to play. So we have Amy. Let's say Amy is buying this adorable cabin in Tennessee, and she's got a really good deal. She bought it for $500,000, and she is using a second home loan, putting 10% down, which is $50,000. So Amy obviously keeps it as a short-term rental, averaging 7 days or less for the average stay. And she does not exceed those personal use days, right? She's going for the 100+ hours, knowing that she needs to log more than anyone else. So she runs it herself, out logging her cleaner. Okay, so right here, obviously this qualifies, which means that the losses can now offset her, in this case, we're saying $100,000 a year salary. Okay, so here's how this could look on a 1-year breakdown. Okay, so purchase price is $500,000. Now, land cannot be depreciated, so we always have to subtract the land. In this case, I'm just using a round 20%. And then we add back in any initial renovations. So let's say she spent about $5,000 in renovations. So now we have a building basis of $405,000. Now we're going to assume that this was purchased in 2026. I'm going to explain why that matters here in a minute. And Amy is going to hire an engineering firm to do a cost segregation reclassification study. And what that's going to do is it's going to reclassify about 30% of the building into short life assets. So that's going to find $121,500 in short life assets. Okay? And because bonus depreciation is now back at 100% for 2026, she's going to be able to take all of that at 100% in the first year. So now we've got some remaining building basis, and it's going to be depreciated at 39 years. And then she's going to also obviously furnish the place, and she got a really good deal on a bunch of furniture, and she's going to spend $10,000 on furnishing. Okay, that also is 100% right off in the first year. So when we add all of this up, the year one deduction is $138,770. Okay, now we said that Amy makes $100,000 a year, and so obviously we are over her salary, which is really exciting. I'm going to share what that looks like on the next slide. So the math on this at a 24% tax bracket would be about a little over $33,000 saved in taxes that either you get it, if you've already paid it in, you get it as a refund, or you essentially just save that $33,000 in actual cash. Okay, so, but again, a lot of people get confused because they say, well, wait, how are we getting this, big write-off when the property's typically cash flow, right? We're getting into these assets because we want the cash flow that they offer us. So again, this is all just arbitrary numbers here. Let's say that she collected $85,000 a year, operating expenses, and then the mortgage. And so her net cash flow is $20,000. But then she gets that depreciation deduction because of that cost segregation. So essentially she's able to write off $138,770. So this is obviously depreciation is paper loss, right? So Amy gets to keep $20,000 in cash flow, but still write off $138,770 on her tax return. So again, here's how this breaks out. $100,000 salary, $20,000 in cash flow, less the paper depreciation. So essentially that wipes out her entire tax bill, and actually would even allow a carryover for additional deductions into the next year. So if we look at this from a return on investment standpoint, Amy put in this example $50,000 down. she made $20,000 in cash flow, and then the tax she didn't have to pay, this would be assumed tax on $120,000, is about a little less than $30,000. So the return on investment in year one on a $50,000 investment is 98%, which is, again, we could do this all day long, right? And so that's an example here. I want to show you some other examples of properties that we're doing. We currently have one short-term rental. We're getting ready to launch our second one when we get back from Europe. And then we have some of these as well that we're currently looking at. So this is an example. I live in Arizona. This is a four bed, two bath house. It's in Mesa, but it's about 15 minutes from Old Town Scottsdale. And so we made an offer on this one. This purchase price would be about $460,000. Again, we subtract the land. This one, we have quite a bit of renovations. The whole pool deck needs to be redone. The whole backyard needs to be redone. So about $75,000 there. So the entire building basis is $443,000. And then again, we'll do the cost segregation. I usually use about 30% of the building basis just for rough numbers to get an idea of what that cost segregation study will produce in terms of tax results. So in this example, just under $133,000. Then we've got the remaining building depreciation that we can take, plus all the furnishing. So essentially this one property, the year one deduction, is a little bit over $190,000. So again, if we apply a 24% tax bracket, it's about almost $46,000 in taxes saved. All right, and then here's another one. This is a property that we actually just looked at last week. This is in Everett, Washington. It's a pretty nice, it's a 5-bed, currently only 2 bathrooms, and big old Victorian style house with amazing water views. And this is an area that we have a lot of new construction, and we have a full team obviously to do this remotely for us. But this one is $600,000. Again, subtract the land, add back in renovations, do the cost segregation, assuming about 30% to short life assets. That's where it gets about $204,000, the remaining building depreciation, the furnishings, and in this case, this property we'd be able to deduct about $296,000 or save about $71,000 in taxes. So pretty incredible there, which I also want to bring up. This is really helpful in the first year, as other hosts know. The first year I would say is probably the hardest. You're trying to get reviews, you're trying to get everything stabilized. So when you get these big tax benefits and tax savings in the first year, it really helps out. Okay, so for those that have questions, maybe this is the first time you've ever heard of cost segregation. I just want to put it really simply. So the cost segregation essentially just speeds up the clock. So depreciation is a deduction that you get to take without spending a dime, right? So everybody gets depreciation. But the thing is, when you have a qualified STR, the IRS actually considers that kind of like a transient lodging, which is like hotel-like. And so the building goes basically into the non-residential category, and it takes it to a 39-year depreciation as opposed to a 27.5-year depreciation. So what a cost segregation study does is it speeds that up. So essentially an engineering firm goes out and they say, well, the components of this property certainly are not going to last 39 years. We're going to essentially recategorize into 5-year, 7-year, or 15-year assets, and we can write those off now. The rest of the building is going to be depreciated over 39 years, right? And then land obviously is excluded. So a couple of things that typically go into the fast buckets, right? So that's going to be your appliances, flooring, HVAC, cabinets, countertops, window treatments, specialty electrical, fixtures, landscaping, driveways, you name it, things like that. So really kind of fun tip here, the double savings with Minoan, so the furnishings and the fixtures driving the deduction are the same purchases that you're already saving at checkout. So I kind of like to say you get the bonus with the discounts from Minoan, and then you get the additional bonus, obviously, from the cost segregation, the bonus depreciation. So it's kind of like double the savings. All right, so also another really exciting benefit that benefits short-term rental owners and just real estate investors in general is that 100% bonus depreciation is back. So normally those fast buckets obviously spread over years. Bonus depreciation lets you take them all in year one or in the year that you do the cost segregation, right? So it's basically like time travel for your taxes, and it was just made permanent last year. So this is for properties acquired and placed in service after January 19th, 2025. So that's really exciting. And then so for placed in service, that is when it's ready and available to rent. So that's not the date that you bought it. So a little bit of a distinction there. All right, and so for those that hopefully were following, but I just wanted to give you a really quick and easy, like back of the napkin math on how to figure this out for your own properties or properties that you're considering buying. So hopefully you guys all have a pen and paper, but essentially this is the formula. So step one is the property price. So essentially what you paid for the property or the property that you're thinking about buying. Step number two, you need to deduct the land value. So if you have an appraisal, a lot of times the appraisal will have the land value there. You could use that. Some CPAs prefer to use the county assessed value. You could use that. Typically in most markets, it's gonna, kind of land in that like 20 to 25% of the purchase price. So you could use that as well. I tend to go with, obviously the lower amount. So if we have an appraisal that shows less than 20%, that's going to be to your benefit. But yeah, so, a couple of different options for formula there. And then the step three is the accelerated depreciation, right? So that's where the cost segregation comes in. I typically use about 30%, which is a little bit on the conservative side. Of all of the cost segregation studies that we have done on our properties, it's actually been a little bit more than 30%. And it's really going to kind of depend on the property. So if you have more kitchens and bathrooms, those usually are going to increase that depreciation bonus there. And then step four is add back the furnishings. So whatever you spent or you're intending to spend on furnishings, you can add those back in. And then you're going to get that full amount. So whatever that amount equates to, as long as you use either the rep status or, in this example that we're really focusing on, the short-term rental loophole, then you can essentially take all of that entire amount off of your income. So if you make $200,000 a year and one property is going to create $200,000 in deductions, essentially your new tax rate would be zero. All right. So there is a catch though, and I want to highlight this because this is something that I see a lot of investors not really think about later on. So the catch is recapture is real, and so there is a way around that. Recapture is essentially when you sell, the depreciation that you pulled forward gets taxed back, right? So the IRS says, hey, we're going to reward you for investing in real estate. Here's the tax benefits from that. But when you sell, you have to recapture or repay that. So just wanted to flag that. Of course, that's something that, people really need to have a strategy. So the strategy is, there's a couple ways around that. Number one, you can do a 1031 exchange inside my portfolio. I would say most of the properties that we have sold have been sold through a 1031 exchange, where you can essentially roll the gain to the next property and continue to defer it. Number two is you could just never sell. If the property goes up in value, you could do a cash out refinance. There's no tax on that because obviously it's loan income that you're getting from a cash out refinance, so you could never sell. And then your heirs are going to have a step-up basis, which would wipe out any of the gain. The third option is a sell and replace in the same year. So as an example, we sold a 7-unit apartment complex that we own in Holland, Michigan in January of this year. and we've already made a few repurchases that are going to wipe out the gain from the sale, the gain and the recapture from the sale of the apartment complex, because we're going to do cost segregations on the properties that we purchased this year, right? So if you run out of time with the 1031 exchange, or you just don't essentially want, to go through the nuances of that, just keep in mind that you can sell and replace in the same year, and do the cost segregation study and wipe out that gain. So, I did want to flag this as well. Just caution, intent matters. So some people say, well, can I do a short-term rental for the first year, use the short-term rental loophole, and then change it to long-term after that? So I wanted to flag that. Just be really careful with strategies like that. That's something that the IRS could flag, and doing an immediate conversion could cause trouble down the line. Okay, so where this sits today, so we are mid-June 2026. There's plenty of time. So for anyone that says, I've had a really great year in terms of income, or I'd really like to get these tax benefits that we're talking about, you have plenty of time. So there's a couple of deadlines that matter. So if you're trying to use this strategy in 2026, you need to have it placed in service, meaning furnished, listed, available by December 31st, 2026. I also highly suggest that you have several real stays on the books before year end, right? So you want to make sure that you can show and prove to the IRS that you have that average stay of 7 days or less. So if you buy something this summer, or even early fall, furnish through Minoan, host through the fall and before the end of the year, then you can show again the average stays by December 31st. Then you are good, right? Lots of time still. Okay, so again, there's one more catch. The hard part is proving all of this. So the strategy is really simple. The risk is documentation. So I have friends who, she's a physician, her husband is a full-time engineer, and they went for rep status. Unfortunately, were audited, and the IRS threw it out because of their full-time W-2 hours, right? So the IRS said, no, you can't qualify for that. So documentation is really, really important, especially with the short-term rental loophole, because there's a few elements of documentation that you need to provide. So you could lose this deduction in an audit if you do not have your hours, essentially date, time, activity, what you did, what property. If you don't have your average stay tracked, and if you're going for the 100 hours and your cleaner or a co-host logged more hours than you did, that is going to be trouble, right? So good records are the difference between a write-off that holds and one that collapses. So again, as mentioned in the beginning, I'm first a real estate investor, second a software owner. So we actually built the STR loophole app that keeps you audit ready. So literally everything in the strategy stays in one place. We have mobile and desktop. So again, you need to track your average stay. It's going to warn you before your average passes 7 days or before you get close. You want to track personal use days. So this is when you're using it, either you or family, and essentially, again, you got to be really careful. You don't want to allow family to use it and not charge them. That could be considered personal use. I did want to flag though, personal use does not count when you are fixing up the property, right? So if you have to go back to your property and make repairs, or you're adding a deck or a sauna or something like that, those are repair hours and not personal use. So you can track that separately in the app. Again, participation hours, it needs date, task, and time, and all of the details, right? So essentially communication log, if you're talking with guests or you're responding to messages, what was that message? What was the response there? So all of that needs to be tracked. Shared with your spouse. So again, if your spouse, let's say, is doing the bookkeeping for the property and you are handling all of the guest messages, you want to track that together and also separately. And then you also need to track whose hours are whose. So if you, obviously the owner, the co-host, the cleaner, everything needs to be kept separate for the IRS. And then I like to include the savings estimate. So for all of this, you want to make sure that it's going to be a meaningful savings for you to put in the time to track everything. right? So that's what the STR loophole app that we built does. You can find it on strhours.com. We're in the App Store, we're in Google Play, and it's called STR loophole app. Okay, so I want to just quickly, before we get into Q&A, a couple of questions that I always get. Number one, when are the savings realized? And that's going to be the year that it's placed in service. Now, when you take the loss is a conversation with your CPA. So for sure, if you have taken a gap year or you've taken a year off, and your income maybe isn't in a higher tax bracket, if you don't have a big tax bill that you'd be faced with, this is something that you might want to wait until you go back to work, right? So that's a conversation with your CPA to make sure that you want to take the losses in the year that it's going to be most meaningful. Number two is, can I backlog my hours or DIY time? So want to be really careful with this. Inside of our software, we actually created an option where you can pull in every calendar event and also sync with, we currently are syncing with Hospitable, and we have more property management systems coming. And essentially you're just taking all of that and then putting it into one place. So I would say yes, that is absolutely okay. I probably wouldn't go years past. I would just focus on the current year and just, again, make sure that all of the details are there. Okay, number three, again, a big question that I get is, does this work for midterm or long-term rentals, right? So unfortunately, the STR loophole does not, because it does not meet that 7-day or less minimum stay. So those would fall into the reps category, which again means that you cannot work a full-time W-2, and then you have to put in 750 hours a year, right? So reps is really for full-time real estate investors. Okay, next one is, do I have to buy a new rental every year? So the answer to that is have to, no. Should you? Yeah, in my opinion, absolutely. So as mentioned, I've been doing this since 2009, and we pretty much buy at least one new property every single year, because that's where you continue to get the tax benefits, right? So for those that say, I don't want to be a full-time real estate investor and have all these properties, no problem. Maybe every couple of years, if you really want to get those tax savings, that's where that's going to come into play. All right, and then again, can I run it as an STR, then switch to long-term? It depends, right? So it comes down to intent. If the IRS says that your intent was to get a tax benefit in 1 year and then switch it, then there could be some issues with that. But let's say that you were forced by law or zoning issues, or there was some reason that you had to convert it to long-term, you're probably okay. All right, let's see. Okay, so again, you can do this. This is something, again, it exists in the tax code. Again, qualify 7 days or less, materially participate, keep personal use low. The way that you deduct is the cost segregation plus 100% bonus depreciation in year one. And then prove it is that you have to track every hour and essentially follow in with the guidelines and the rules of the STR loophole. So you can learn more. Also, if you want to calculate what this could look like for your property, we have some calculators at strhours.com, plus a ton of information on this strategy. So you can head over there, again, kind of go down a rabbit hole of learning about all of this. And it's all there. So I think I'm going to go ahead and stop the share and see if we have questions. I think we've got, maybe
we have a lot of questions.
Oh, fantastic. Okay,
Okay.
great. I love it.
So I will just go down the list, everybody. We're going to start with Buck. He said, if I want to execute the 100-hour material participation test, what is your favorite framework for outsourcing tasks without blowing past the cleaner's hours? For example, do you recommend self-managing guest communication while outsourcing the turnovers? Or do you have a specific co-hosting structure that keeps the owner's hours the highest?
Yeah, so that's a great question, Buck. So first and foremost, I would look at, are you using the same cleaner every time, or could you swap out? And then also, what is your average stay? So for example, my average stay is like 3.7, or I don't know, it's like 3.5 days or whatever. So our cleaners are there all the time. And Katie is her name. She spends about 4 hours on every clean, which could be essentially, that's like 8 hours a week. So I have to beat her in that case, or you can swap them out. So if you have a second cleaner, then in my example, Katie is 4 hours, and then the next clean, you use a different cleaner in there 4 hours. You just have to beat the 4 hours and not the 8, right? Obviously be mindful that you have to track that, but that's really important. So we manage most of our properties actually in-house, and I just have automated systems set up, and so everything gets logged based on the automated systems. So that would be my advice, Buck, is again, go back to what is your average stay? How long does it take your cleaner clean? And then even if it's, again, the same company, could you say, okay, Jane, you clean one clean, and then the next cleaner comes the next time, and then you just have to beat their hours. Now, how you beat it, again, is guest communication. If you're running guest communication, super easy. Anything that you're doing, maybe if you're going into Airbnb, swapping out photos, changing the description, I actually find that the algorithm rewards that, and then you get to the first page, higher conversion that way. So I would do things like that. Keep your inventory list, do your own bookkeeping. I mean, there's a lot of different things that we can go into. If there's more questions around like how to get those hours, it's actually pretty easy when you add it all up.
Yeah, great. A couple people asked, does travel time to the property to do repairs and cleaning count as working?
Oh, yeah. So that's a multi-layered question, and it's a bit nuanced. As a non-CPA, I'm going to tell you how we do it. Okay, so it gets into a little bit of like, do you have a home office or not? And then it also goes into, do you have other properties that then you're going to be going back and forth to? So to just answer simply, obviously always check with your CPA because everybody's situation is different. I can say with some level of certainty that if you were to go to the property and then go to Home Depot and back, that is absolutely travel time, mileage, time shopping at Home Depot and doing all of that for sure. Now, from your house to the property is probably going to depend on, again, do you have dedicated home office and things like that. I would say that depending on if your CPA is rather conservative or not, they might say do not count travel time from your primary home to the property. But again, if you're like renting an office space and you're going from there, then again, it's a little bit different.
Okay. What if a property has 2 homes on it and we use one as like their personal home and one that's an STR?
Okay. Oh, I love this question. That's a really good question. So in that case, and they're detached. So typically you're going to run the short-term rental as if it were not on your property, right? Now, what gets a little bit tricky is how do you handle like property taxes? So your CPA is probably going to do some kind of, I would say math on that is STR takes up this much of the property, primary residence takes up that much of the property. That's where it's really going to fall into play. Insurance is another one. My guess is that you're probably going to have a separate insurance policy for the short-term rental itself. So obviously that can be deducted on the short-term rental side, but you can still do a cost segregation on the building itself. So there's no issue with that. The other thing I think is obviously just watch personal use. So if you have a lot of family visiting in town and they use your short-term rental when they're in town, I would track that personal use and I would just be mindful that you don't exceed what is allowable when using this strategy.
Okay, great. Let's see. So is the STR loophole, this is from Sadie, is the STR loophole voided if I host STR short-term rental and midterm rental stays in all my spaces? I feel like the average is more than 7 days since travelers often stay for 13-week contracts.
Yeah, Sadie, that's a great question. And it's the reality for a lot of hosts these days, especially if you're in a very seasonal market. So if your average stay is more than 7 days, then I would say that yes, you would not qualify for the short-term rental loophole. Now, though, On the flip side, if you have several rentals and you don't already have a full-time job, like if this is your full-time job, Sadie, then I would look at qualifying for rep status, which is basically, I don't want to say the same, but it allows you to get that tax wall that we talked about where you're either active or passive income. That could potentially be the door, the opening to get all of your passive losses for the properties into that, obviously, writing it off against your income with the reps qualification as opposed to the short-term rental loophole.
Cool. We had a couple questions about the cost segregation study. So just
Yeah.
kind of like, how do you find cost segregation engineers? What does a cost segregation study generally cost? And then at what point do you engage a cost segregation company after operating the short-term rental for a few months, or is there a seasoning period?
All really great questions. Okay, so let's break it down. So I typically work with a company. It's U.S. Tax Advisors. If anyone wants like a direct introduction, you can send me an email and I'm happy to make that introduction to you. So the cost is going to depend largely on the property. So I would say on average, you can expect to spend about $1,500 to like $2,000 on some of our larger apartment complexes. It's been like $3,000 to $5,000 because they're going into multiple units and it's a large property and things like that. But again, on average, $1,500 to $2,000. Now, when to engage them? So it's really interesting. You can actually do the cost segregation either in the tax year or after. So, for example, if you are trying to use this strategy for your 2026 return, you just have to do it before you file your 2026 taxes. So, if you extend, that would be you have until essentially October 2027. Or if you file in April, it would just have to be done before your April filing. So remember that the cost segregation is going to be based on when the property was placed in service. So if, like, let's say you're buying a property right now and it's placed in service in the fall, but you want to use it for your 2026 tax return, again, just do it before April or October, depending on if you file in April or October.
Great. Can I take advantage of the loophole if I convert a long-term rental to a short-term rental?
Okay, yes. Now you have to do a reclassification of depreciation, which can be a little bit tricky. There are forms for this, and that's not a problem. We're actually going through this right now. We own a duplex in Idaho that's like brand new. It's in a really cute area. So we're going to convert one unit as the tenant moves out into a short-term rental and then run the long-term rental on the other side. My CPA is like, so it's gonna change things a little bit. But because we already own it and because it was already depreciated and on a depreciation schedule as if it were a long-term rental, 27 and a half years, we're gonna have to file a change in depreciation and then get the cost segregation study in to get the extra bonus and benefit there. So yes, absolutely, it's very nuanced. So talk to your CPA ahead of time. And then just know that you're not gonna get, again, depending on how many years you've owned it, you're gonna have some depreciation that you've already taken. And so the benefit isn't quite as good as if it's all in the first year. But still, you can absolutely do it and use this loophole for sure.
Perfect. Let's see. Are the advantages of this loophole only for individuals, or can partnerships and LLCs also utilize this?
So great question. So it's going to follow the taxpayer. So I've actually had situations where we'll do like a partnership on a property, and then maybe one partner wants all the tax benefits and then the other partner doesn't need the tax benefits. So you can absolutely do that. I would put that into your operating agreement, but I would also make sure that the taxpayer that is claiming the benefits also follows all the rules, right? So what you don't want to have is the IRS saying, well, wait a second, Taylor and I get into a partnership. I'm running all of the business and then Taylor is getting the tax advantages. The IRS is going to say, great, Taylor, where is your log? So be really careful about that. Again, absolutely doable, provided that the taxpayer is the one that is doing essentially the material participation and getting the benefits from there.
Perfect. Justine says, we bought our home in July of 2024. We hired a management company who listed it in October of 2024. First day was November of 2024. We're moving to self-management starting in August, and I'm doing all the work to get it ready, supplied, painted, listed, etc. Can we use the STR loophole for tax year 2026 since we are doing everything? So
So,
it's been rented as a
yeah,
short-term rental since 2024, but with a management company.
right. So that's a really great question. A couple of things that were flagged. 2024 was initial placed in service day. So that is also, it's not 100% bonus depreciation, unfortunately. I'm assuming, obviously, in this case, that you have not done a cost segregation. So unfortunately, I think it gets a little bit tricky when you have a placed in service date of 2024. So again, you're not going to take advantage of the 100% bonus depreciation. Now, this is one that it's very nuanced, so I would for sure talk to your CPA. I want to say that yes, you could qualify for the STR loophole because if you meet the 7 day, obviously 7 days or less, in terms of the average stay, and now you can meet the hours, just know that the tax benefit is not going to be quite as enticing because of your initial placed in service in 2024. But what they can do is they can do kind of actually a reclassification of the depreciation for sure if you had not been taking it essentially. Again, I'm assuming that there's no cost segregation done. So you could do a cost segregation, say like in 2026, like you could do it this year, but they're going to go back to the place in service date of 2024. So again, you can do it, but it's not going to be as beneficial because bonus depreciation was not 100% in 2024.
Got it. Some kind of quick hitter ones. Melinda said, so can you not use this loophole if it's in an LLC?
Oh, no, LLC changes nothing. Yeah. So LLC is a disregarded entity when it comes to the IRS. Actually, every single property that I own is in an LLC. So yeah, so LLC is no problem.
Cool. Can the cost of the cost segregation be added to the list of deductions?
Yeah. So similar to like tax prep fees, that's going to be probably more of like a cost of doing business expense, like more of like an operating expense. So yes, absolutely.
Can the STR loophole be done without a cost segregation study?
Yes, but it's not going to be as beneficial. So essentially, so remember what the cost segregation study does is it accelerates the depreciation. Otherwise, it's just going to be the property is going to be depreciated over 39 years, right? So you have to take the depreciation slow, essentially. So in that case, you would just take purchase price less land, whatever that amount is, divided by 39 years. What the cost segregation does, though, is it allows you to essentially front load all of the depreciation for the short life assets. So again, take like 30% of the basis and you can take it in year one. So in my opinion, you also have to just run the math. Now, if you have a really expensive, like couple $1 million property, and let's say you have it under management, you'll have to take a look at, okay, well, what is the depreciation on an annual basis with that 39 years taken into consideration? And then unfortunately too, that depreciation can only be used against other passive income, not active income, if you don't use the loophole. So there's kind of hopefully that makes sense. The two strategies is the cost segregation allows you to short life a lot of the building components. And then the STR loophole is what allows you to break through that wall of passive versus active income.
Cool. So this just covers property ownership, but does this strategy, is it viable if you're doing rental arbitrage?
Oh, okay. So that's a great question. Unfortunately, if you do not own the asset, then you do not get the tax benefits. So you'll get obviously other, expenses running a business, but because you don't own the real estate asset of itself, then you don't get those tax benefits.
Got it. Let's see. I think we have time for like one, maybe two more here. So what if we do all the work? No cleaners and hardly any repair people. Do we automatically qualify?
So potentially, just you have to remember there's like automatically qualify or qualify and actually have the evidence to back it up. So the IRS is really great. The tax code is completely written for business owners and real estate investors. I mean, that's the truth. But the burden of proof is on us, right? And so we have to actually provide that evidence to the IRS if they come knocking on our door and say, well, wait a second, you've been benefiting from all of these tax benefits, which is great, but show us the evidence. If you don't have the evidence, they're going to throw it out. And I've seen this time and time again in audits where legitimately the people worked the hours, but they don't have the evidence to back it up. And that's a really, really big risk.
Okay, last question. If you own and self-manage other rentals, non-STR, do the hours spent on those count towards the STR loophole hours?
No. Yeah, so great question. So now, unless you're qualifying for reps, if you're going for rep status, that's different. So, but if you're looking to do the STR loophole, and let's say you have W-2 and you're managing other like long-term rentals, the STR loophole only works for STR or short-term rental properties because at that point, again, that it's that average stay, 7 days or less is what gets you into that loophole, and it's on a per property basis. Whereas reps looks at typically you group the properties together and then you have to do the 750 hours materially participate, and you cannot have a full-time W-2.
Yes. Okay. Thank you so much. This was such great information. I know we didn't get to all the questions. I'm sorry, guys. We ran out of time, but we will definitely be sending out Jennifer's website and some ways to get in contact with her and everything. So if anyone needs anything, she's here to help. And we will be sending out a follow-up email that has this recording and, like I said, other links and all of that. So thank you, everyone, for attending. And we hope to see you next month. Thank you so much, Jennifer. We really appreciate your time.
Um,
All right. Bye, everyone.